Up next on the SRI 360 podcast.
The company has three center points. One, sustainability is about competitive advantage and shifts in value. Two, it's expressed in real assets. And three, we focus on institutional clients. What happens when that climate changes? People don't really think about climate change. They talk about it a lot, but they really don't think about it a lot. Of all the places in the world to think about being the vegetable capital of the world, Holland would not be one of them. And it is literally a powerhouse. One of the largest build-outs of glasshouse infrastructure in the last decade was Russia. So you're going to see the idea of rethinking agriculture taking place on multiple dimensions.
The SRI 360 podcast, presenting world-class investors and experts, passionate about improving the world and making high-performance returns through unique ESG, impact, and socially responsible investments. Here's your host, Scott Arnell.
Hey everybody, today I am visiting with Dave Chen, and Dave is the founder and CEO of Equilibrium, which is a sustainability-driven real asset investor in the agriculture and food and the carbon transition infrastructure sectors. Dave is responsible for strategy, executive leadership, and developing the firm's investment products and asset strategies. Formerly, Dave was a general partner at OVP Venture Partners, CEO and co-founder of GeoTrust, and the founder of the Ascent Group. Dave has served on the San Francisco Federal Reserve Bank Board and is an Adjunct Professor of Finance at the Kellogg School of Management at Northwestern University. And now, please meet Dave Chen.
This sector's moving pretty fast. Yeah. And there are some clear demarcation points that are happening and chapter changes that are taking place in this field. And to me, those are the more important things to be talking about. You know, in some ways, buried in Ronald Cohen's book is actually the germ of some of the really important changes that are taking place. And for him to say that, because he was in, the Johnny Appleseed of some of this stuff, is actually pretty interesting.
Dave, can you first talk about the investment opportunity you saw in sustainable real assets? And what was the genesis behind the formation of Equilibrium Capital? And how did you decide to focus specifically on food and agriculture?
So Equilibrium, we formed it about 12 to 13 years ago, and we had a very simple premise, and that was that sustainability was not couched in the word advocacy or responsibility. Sustainability was couched in the word competitive advantage. So we saw it as sustainable trends, sustainable services, sustainable products, sustainability, which at the heart of it was effective use of and productive use of resources. If you cracked it, was a competitive advantage. And the reason that we were so compelled by that is that we're effectively students and we go to school on people. And we had the benefit at the time that we formed the company of going to school on people like Ray Anderson. And Ray was, I'll call it a showman and marketeer enough to know that he put a face on his company interface that spoke about biomimicry, but the substance of what he did in sustainability was all about productive reuse of waste streams, recycling, closed loop, stretching. So these were all boring, mundane things. And so he was a balance of sustainability being substantive expense and competitive advantage, and showman enough to be able to talk about the snap and sizzle of sustainability. And there were dozens of folks that we got to know that had built these multi-billion-dollar enterprises or very significant enterprises that were attacking sustainability not at the high level, but at the substantive, minutia. We developed an investment thesis that said that sustainability was a competitive advantage, that it was about an economic shift, and therefore it was about mispriced assets and market inefficiency at the information level. And we came to the conclusion that if that were the case and that we could uncover this, then we would see an alpha opportunity, right? And at the time that we created our company, most of the conversation at the time, you have to remember 12, 13 years ago, was around impact investing. And that's centered around social enterprise. And the other stream was the legacy tapering down of the life cycle of SRI, which is all about exclusion, right? And quote unquote being responsible. And we saw the opportunity for what is effectively an alpha play, right? We saw that we could best express that advantage in a category that was very large and largely not professionally managed, and where institutional capital had not really made a presence, and that was in the area of real assets. We saw sustainability as being not an asset class, and there was a big conversation 12 years ago about this being an asset class. And we didn't see it that way. We saw it as a strategy that cut across all asset classes. But the asset class that we chose to penetrate was the area of real assets. And then specifically, we saw that the big real assets categories, real estate, forestry, agriculture, energy, these were all massive real assets categories. And we chose ways that we could use what we perceived our competitive advantage to build portfolios within those. The second heart of this company is that at the heart of it, our DNA is that we're value chain analysts. And because we're a small player, you have to look for value chains where a significant shift is taking place driven by sustainability, where it allows a new player to take advantage of that shift in the value chain to create a position. All right. And I'll go into an example of that in a little bit. And then the third thing, and this was a decision that we made about 2010. And I remember, you have to go back and be a historian. Around about 2010, the center of this conversation, whether it was SRI, sustainability, or impact investing, centered around ultra high net worth. And we made the decision that the ultra high net worth market that was interested in this category was very much about advocacy and not about putting a lot of money to work. 2010, we made the hard decision that we were going to go counter to the trend at the time. And we would go back to what most of my team knows, and that is institutional investors. So beginning about 2010, 2012, we went and focused our company on building these strategies for pensions and sovereign wealth funds. And our message, we believed, and our strategy, we believed, would resonate with them because we talk about sustainability in the vocabulary of risk and the vocabulary of opportunity and competitive advantage. All right. So the company has been built on those three center points. One, sustainability is about competitive advantage and shifts in value. Number two, it's expressed in real assets. And number three, we focus on serving institutional clients.
And who are your investors today, and how have they changed over time?
So today we've got about $2 billion on the platform. I would say that about 90% of our clients are pensions and sovereigns. At best, we have 3-4%, quote unquote, impact investors. And at best, we've got 3-4% that are endowments or foundations. So when we started in 2010 or 2012, that time frame really going out to the market, I would say that the vast majority of our capital was not mandate-driven capital. It was plain vanilla asset allocation out of the real assets buckets. The funny thing is, as the world has evolved, as you know, in the last 3-4 years, many of the institutional investors have evolved with sustainability or climate adaptation overlays across their entire portfolios. And that's accelerated over the last, I'd say, 2 years. And the vocabulary that we chose to use over 10 years ago of speaking in the language of risk and in the language of opportunity, the language of market inefficiency or efficiency, is what has resonated. And now what we find is that whereas 5 years ago I would have said that most of the investors that we have allocated to us out of non-mandate oriented buckets, I would say that most people now that we are investing with, we fit a mandate, in many cases retrospectively. And
so
that's
a pure real asset mandate without sustainability overlay for reporting purposes and things like that.
Except now, today, the reality is everybody's got an overlay, so now we fit.
And that's allowing you to scale then.
Yeah, it's allowing us to scale. And our average investor is probably writing us a $50 million ticket. And we invested very early on. For a company of our size, we had no business building our own internal IR and asset gathering team, but we did. And in part because our DNA is long-term and value creating. And so we decided that very early on that it was very important for us to have the investor relations that continue to add value to our LPs in terms of their thinking, in terms of how they were evolving, their sophistication and their needs. And the only way to do that is to own that relationship and own the responsibility of that relationship. So we've never used outside fundraisers. We've never used outside placement agents. And we maintain very, I'll call it intellectual property driven relationships with our LPs.
So how many funds do you actually have?
In our history, we have started 4 platforms, 2 of which are proprietary, and 2 of which we started in partnership, and I would call them affiliates. We started a $1.2 billion platform called the Girding Edlin Green Cities Funds. And that was done in collaboration with Girding Edlin. That was how we actually started. First green real estate fund platform, right? The second platform that we initiated was the Agricultural Capital, AC. We did that as a 50-50 joint venture with a company called Agricare that brought the domain expertise, and we brought the asset management and the strategy for the fund. And that subsequently became an $800 million platform. And then our 2 proprietary platforms are our wastewater energy products, and that's approximately a $300 million Fund 1, and its follow-on, I'll call it SMAs. And then our Controlled Environment Foods Fund platform today is approximately $1.4 billion.
Now, are these closed-end funds or?
They've all been closed-end. You'll ask the question, if these are long-term real assets, income-bearing products, shouldn't they be open-ended? And shouldn't they be long-lived? To which the answer is, you are correct, and they should be. And at the time, 10 years ago, for investors, and more specifically, some of the consultants, to sign off on an open-ended fund or an open-ended investment vehicle was something that everyone talked about, but very few actually accepted. Only today that folks are starting to ask the question now and want to allocate to open-ended vehicles, whether they're REIT-like structures or not, or open-ended fund vehicles, for being the logical receptacle to long-lived assets, which are income-bearing and, playing in the right set of growth-oriented sectors.
If it's closed-end funds and you're investing in these high-tech greenhouses, which I'd like to get to at some point, what's the exit strategy for that if they're closed?
There's 2 broad exit strategies. One is you can sell them off one by one, and there is a market for secondary sales, in effect, a piece of specialized real estate. And then there is the opportunity to place them into a long-lived REIT-like structure. There's an active secondary market. In our wastewater energy, and this was announced, you might have seen that we sold and exited one of the largest dairy renewable natural gas facilities, dairy RNG facilities, earlier this year for $130 million. We haven't disclosed what the returns are, but it's in the high double digits. It's not high teens, it's in the high double digits.
And for the pension funds, they have to match their liabilities and their investments. Are they locked up for a long time or not?
Yeah, they're locked up. Our funds are your pretty standard private equity structure, which is 10 years plus 2 or some derivation of that.
Another thing I've seen you say is that you're investor operator. Does that mean you're like a data center company where you build these greenhouses and then you operate them and then lease them out to agricultural operators? Or are you actually operating them? How does that work?
It depends. So in our agricultural capital platform, because of the time frame when we created that strategy, we did not believe that there was enough expertise out there in high-scale implementation of sustainability-driven strategies. We actually took a complete vertically integrated strategy in that fund where we were, in fact, literally the farm team, as well as the owner of the farm, as well as the owner of the midstream assets. All right. In our renewable natural gas, wastewater energy portfolios, because we entered at a time when the industry was relatively nascent, we took on probably at the time more project development responsibility than we would have actually wanted to, but it was necessary at that stage of the industry. And then to date, we have continued to employ or to outsource, but to manage the outsourcing of the O&M, the management of those facilities that produce renewable natural gas. So these are $50 million, $80 million assets that we're talking about here, right? And so when we talk about being an investor operator, it means that we always have enough expertise on our team and enough focus on these asset types that if we need to, we're capable of going in and actually operating those assets. In the greenhouse space, we are now, I think, at this stage of the game and of that sector in North America, among the largest owners of greenhouses in North America. And I would say that on our team is the depth of expertise driven by the fact that we've hired, with that in mind, a set of expertises that are necessary to step in if necessary. But in all cases, even if we're not stepping in, we have the expertise to understand the economics of the industry, the economics of the operation, to be a partner to the best greenhouse companies and operators in North America.
So your returns then are a combination of operating income and then your exits.
Correct.
That's quite different, I think.
If I use a real estate analogy, and you're well aware of real estate, you have value add funds, but the vast majority of the real estate capital is in core and core plus funds. If you look at the entirety of the TIMO industry, timber, almost all of it is targeted at income producing. If you look at the entirety of historic agriculture and how different we are from historic agriculture, almost all historic agriculture investing, other than pure private equity, but land investing, has amounted to three phrases. Land, God ain't making any more of it. We have aging farmers, so we have a buying opportunity. And three, the Chinese middle class is consuming better food. And so it's always been an income producing, land-based, land rental, land lease income producing strategy.
Your controlled environment food strategy, that's all these smart high-tech greenhouse buildings.
Correct.
Primarily that, yeah. It's like $2 billion, I think you said.
It is exclusively in high-tech controlled environment greenhouses.
The crops that are grown in those greenhouses, what does it span in terms of the crops that you're targeting for that?
There are three broad categories of crops that are currently contemplated or exist in greenhouses. One is what are known as vine crops, and those are generally tomatoes, cucumbers, and the peppers, but they include also other vegetables like green aubergine, eggplants, right?
Yeah.
And that is the most mature category of greenhouse grown crops that traces its history back to the Dutch and the Dutch powerhouses of greenhouses. The second category, and it's much more nascent, is what is broadly called leafy greens, which would include lettuces, spinaches, and then the incredibly nascent field of Asian vegetables. Asian vegetables are very important because we're Western centric. We forget that there's 4 billion people on the other side of the planet that actually have a very high vegetable-oriented diet.
I noticed that you announced one investment in Mexico. Do you have a lot of investments outside the U.S.?
We see growth globally, and we see growth in the North American food system in Mexico. Mexico is already, and has been for many years, a major part of the U.S. food system, sourcing from Mexico. And we believe that in spite of the U.S.-Mexican issues over the last 4 years, from everywhere from trade to immigration, despite all that, Mexico will remain a major food partner, especially in the area of vegetables and fruits for the United States. Our objective is to make sure that we are investing in the food system and the food sourcing systems necessary for a North American food system.
So you're primarily focused on North America then?
For now, because this is where we live and this is where our expertise is. But I would not be surprised if you saw us enter into Southeast Asia over the course of the next 12 months. And I would not be surprised if you saw us enter into Northern Europe in the course of the next 12 months.
We live part of the time in Amsterdam, and I've seen huge greenhouses there. Is there anybody doing the same thing you're doing there with the same technology, or are you unique in that?
The wellspring of knowledge in this area is Holland.
I somehow had the idea that you were unique in this approach.
Are we unique as an investment manager in targeting this sector? Yes, we were the first. Are we the fountain of technology for this area? No, that would be hubris. Okay. The fountain of knowledge for this area centers in Holland, and to some secondary extent, Israel. And that is where the systems, the technology, the expertise, the computing systems, climate management, water management, even the biosystems that occupy that, and including the genetics. Much of that centers in those two locales.
I presume you're not taking technology risks. And then what about technology obsolescence? I've seen a presentation you've made. I might not have the numbers right, but I think you were talking about historically, you look at an acre of land, our agricultural land valued at 40,000, and now with all the technology, it's 2.5 million or something in the US, I think. Most of that is technology. Then there's technology obsolescence. Is that
correct? That is correct. In the same way that a data center owner, the landlord, has to maintain a constant evolution of the underlying infrastructure of the data center, or else they have an old data center. They might suffer from the fact that they have an inefficient data center or a non-cost competitive data center, for the same reason that those assets need to be kept up to speed, up to technology on life cycles. The same way that if you look at the way you underwrite solar and large-scale wind fleets, you build into it that every 10 years or every 7 years you're upgrading this system or that system. The windmill blade may have a useful life of 20 years, 25 years, but the gearbox is changing. The software management system is changing. And in the way that any of these technologically dependent long-lived assets have to be maintained and upgraded, we do the same thing in our underwriting and the management of our assets.
You've talked a lot about inflection points. You mentioned Asia now, but do you see other inflection points, or how do you incorporate your inflection points in your strategy?
I think in two ways. One is it allows us to ask the question, if we don't want to take technology risk and we're in these food systems, which are, no matter how you dress it up, it's still a commodity. So I don't care how much technology you put into a salmon, it's still a salmon. We forget that Elon Musk only sold, I don't know what it was, 1,000 Roadsters. And it wasn't until the Model 3 and the Model X where you see mass consumption. We're in the commodity business. And so you have to hit price point and you have to hit cost points. And so the S-curve analysis is critically important for us, because it's about when is a sector or a technology S at the flat part of its development curve. In other words, it's not competitive, but you have to watch it because it will become competitive. When does it hit competitiveness? And so we apply that very simple logic to, for example, aquaculture RAS systems. We apply that very simple concept to things like vertical farms. We're agnostic. We're just trying to figure out when these things hit the curve, because we're real assets investors, not venture capitalists.
You've referred to distributed abundance. In the long term, you're unlinking or unhooking geography and climate from where things can be grown. What's the long-term impact that you think that's going to change?
So the easy ag strategy for years and years has been to find great Mediterranean climates. We want to live in Mediterranean climates. grow crops in Mediterranean climates. And that's all beautiful when the climate is stable. But people don't actually believe in their own bullshit. So if you actually believe that climate is changing, what makes you think that the Mediterranean climate, which isn't movable, that hunk of land that is in sweet spot Provence, that is gorgeous Mediterranean climate, if you believe your own bullshit, you believe that the Mediterranean climate is changing. So what happens when that climate changes? And it can change on the up or the down. It can be drier. It can be wetter. It can be sunnier. It can be cloudier. And people don't really think about climate change. They talk about it a lot, but they really don't think about it a lot. So let me take an absurd couple of examples to illustrate this. Let's say that you picked Provence because it has 330 days of sunshine a year, and you cite your beautiful wind farm and you cite your beautiful solar field in Provence because it's so damn gorgeous. And you underwrote it for 330 days of sunshine for your solar. And because every day is very stable and predictable, you know that the morning starts off with mild breezes, beautiful for having your cup of coffee. And the afternoon, because the earth heats up in Provence at a very predictable rate, you get these beautiful, gentle winds that come whipping through and cool the day, but also generate wind. Very predictable. Beautiful, predictable as hell, right? So you cited your gorgeous wind farm and you cited your gorgeous solar field there. All of a sudden, Provence's climate changes so that it's cloudier and the temperature gradient starts to change. It's still beautiful, but a 10, 15% change in the weather pattern, more clouds, you've changed your underwriting about the number of photons that strike your solar field. So your underwriting's off. And the wind now is not as predictable because the ground heats up differently. And now all of a sudden your wind is volatile, right? This now disrupts your underwriting. And you underwrote it with the assumption that what is historically true will be historically true in the future, all right? And climate is changing. And agriculture is ground zero for climate change. So how long will this beautiful piece of dirt that you bought, which is not movable, right, that you bought because it was beautiful Mediterranean climate, no longer is beautiful Mediterranean climate. Right? And you know that the greatest predictor of quality and quantity in agriculture is the weather. It's why in all the movies you hear guys in the trading pits screaming about, my God, did you read the weather report? You know, Brazil is going to go into a drought. Orange juice prices are going to go nuts, right? You get three farmers together anytime over a cup of coffee or a cup of tea anywhere in the world. And within a minute or two, the topic will always turn to weather. Why? Because agriculture is about weather, right? So when I talk about distributed abundance, the same reason that Saudi Arabia is a country with a border that happens to sit over a massive pool of dead dinosaurs, they won the country lottery, right? The reason the United States became a superpower in the 1800s and 1900s is because we had the Mississippi Valley that had a river across one of the most fertile places in the world that was huge and had access to a transportation network. So we won the climate and geography lottery. It wasn't anything we did. Now, when climate change starts taking place and weather is the number one predictor of quality and quantity, and if you actually believe your own, as I said, bullshit about climate change, then the lottery ticket changed. The second thing is resiliency, and COVID gave resiliency a face. Resiliency was a fun word to say on panels because it made you look smart. COVID actually made it visceral. And so now we have, geez, if I can DIY climate, controlled environment agriculture, if I can distribute that away from the land and away from the climate to anywhere, right? One of the biggest build-outs of greenhouses in the last decade was Russia. It's really hard to grow a tomato, okay, when most of your year is cold and dark. So one of the largest build-outs of glasshouse infrastructure in the last decade was Russia. So that's the ultimate in DIY and BYO. Bring your own. Do it yourself.
How does that change the economics of the places that were heretofore the centers for that production?
You sort of have to appreciate the absurdity of that situation, right? There's a little bit of exaggeration, but the National Geographic article wasn't that far off. I mean, the Dutch, of all the places in the world to think about being the vegetable capital of the world, Holland would not be one of them. It's dark a lot. It rains a lot. Okay?
Yeah.
It's not a big country, and it is literally a powerhouse. One of the things that we do in our shop is we always look at something that we used to use as an expression at McKinsey, the existence proof. Does it exist? You can argue all you want about absurdity, but does it exist? And the existence proof of grow the abundance in a distributed way in places where it frankly would be absurd is Holland. And then the Israelis. It's not an exaggeration. You're living in a desert. There isn't that much water. It's absurd that this would be the place that you would actually grow vegetables and fruits. It wouldn't be the ideal place if you had to select the world. So in the challenges that we have in the next few decades, water stress, climate volatility, climate shifts, the need for resilient food systems, the need to reduce volatility, potentially in times where the natural systems are going to become more volatile, the desire for regionalism, the need for food safety. There's any number of reasons that will drive this trend. And we saw that and we wanted to bet on it. When we started the fund 5 years ago, we used the wording that this was a complement to the field agriculture. Increasingly, it's becoming a replacement for field agriculture.
Do you see it broadening out beyond those three categories?
Yes.
Where do you envision it could move to? For example, I come from the Midwest. I think you went to university in the Chicago area. That's where I grew up, and actually on a farm. So I know all about the farming community out in Illinois, Indiana area.
Yes.
Is that going to be impacted by this type of technology?
I think it's a long time before we start talking about grains and other things, right? But the idea of controlled environment agriculture, in many ways, if you think about it, the use of fermentation sciences to produce the proteins and fats, most of the proteins, but ultimately to manufacture the fats that are in dairy products and bring the health of dairy products, but not use the cows as much. And we're on the precipice of that, right? So you're going to see the idea of rethinking agriculture taking place on multiple dimensions. And so the reason that we called it the Controlled Environment Foods Fund and not the Greenhouse Fund, and the reason that the S curve is so important to us, is that we see a successive series of S curves that we will be attaching ourselves to.
Where do you see the more likely targets?
We haven't even begun to touch the fruits yet, and the families of leafy greens. Here's the problem. Most people don't do back of the envelope math. They talk in hyperbole about feeding the world. They talk in hyperbole about the next generation of agriculture. But if you just whip out the back of an envelope and just do some numbers, you begin to realize that if you're going to do that, the scale of change that's going to have to take place, the scale of execution that has to take place. And as you know, there might only be a dozen technology firms in solar and in wind that make the windmills and make the solar cells. But it's the ubiquity of the solar fields that everywhere you drive and everywhere you look is a windmill farm. So in the world of climate and climate adaptation and climate change, it's really going to be the infrastructure development as much as the technology development that will actually be the lever that we use to change the world. So as important as it is for us to talk about the companies that create the solar cells, it's also important to look at the infrastructure investor and the infrastructure developer that has made it ubiquitous across the rooftops, that has made it ubiquitous across our countrysides. And the same thing will happen with the food system.
By having the controlled environment, you eliminate a lot of the uncertainties in agriculture. But are you still somewhat geography constrained due to light? Can you overcome lack of sunlight?
The whole focus of the vertical farms is to actually enclose a building and use artificial light and management of light spectrum. but that's a function of energy. And so there's always gives and takes. And as much as you want to see these as panaceas, they solve some issues and create others. And so it's all about the management and the rebalancing of those aspects.
I guess my question is there other constraints on this at some point?
But again, we go back to the existence proof. And that this is because people don't really understand where their food comes from. The existence proof is that in Switzerland, for almost your entire adult life, you have been eating greenhouse tomatoes because they came from Holland. And there's a very small period of time in the summer where they're coming from Spain and Morocco. All right. And there's a minute amount of time where it's coming from the Swiss farm. But by and large, you're eating a Northern European greenhouse grown tomato for most of your adult life.
And we have blueberries all year round, which we did not when I moved here 30 years ago.
And what's exciting is there's a phenomenon in technology curves where the first part of the curve of most new technologies is about doing something that you used to do faster, better, cheaper. Right. And then about 3 or 4 years into that technology, you wake up one day and you go, wait a minute, this allows me to do something completely different, not just faster, better, cheaper. All right. So the internet started off, hey, I get to see sports scores, stock, and weather all the time. Right? And who would have thought that it would end up doing and rethinking entire value chains and entire new industries? When the smartphone first came out, it was literally those three things: stocks, sports, and weather, right? Yeah. And texting. All right. Who would have ever thought that a few years later you'd use it as a remote control? All right. So greenhouses are going through the same thing, which is, wow, I get to grow tomatoes and lettuce faster, better, cheaper. All right. And then you'll see a second hop. So we've had discussions about strawberries. So here's the thing. The strawberry industry has always been focused in the US, and I won't talk about Europe, but in the US, the strawberry industry was focused on how do I get a strawberry that is grown in God's gift to strawberries, California, to the consumer on the East Coast. So the strawberry genetics and the breeding of strawberries is so that I can actually grow something that can weather or actually transport and sit in a truck and get bounced around for 6 or 7 or 8 days, make it through a storehouse on the East Coast for another 3 days, and then go to the grocery store and sit for 2 or 3 days, and then sit at home for 7 days. That's a lot to ask from a fruit, especially when it's soft. But all joking aside, that's what created the strawberry industry in the US, was the ability to solve that problem. All right. And now today, because we're discriminating consumers, we make fun of the California strawberry and we criticize it. But we have to remember that in the 80s and 90s, this was a miracle. All right. Yeah. I can get a strawberry in New York City in winter. It may not taste great, but geez, my measurement of goodness was much lower back then. It was just, I get a strawberry in winter. So now if I can grow the strawberry close to you, so the first wave of technology of a strawberry is, my gosh, I can put a strawberry greenhouse in New York and I can provide a better tasting strawberry. I don't have to use the California genetics. All right. What if one of the leading yogurt makers says to you, hey, listen, since you guys are next door, can you grow a variety for me that is incredibly beautiful and tasty, but by definition is incredibly fragile and perishable? Because if you can grow one that's got beautiful color, beautiful flavor, and has high sugar content, and I'm willing to accept that it's fragile because you're now next door to me, I would make a yogurt that has nothing other than dairy and a strawberry, and I would label it as no color, no sugar, no flavor enhancement, nothing but a pulped strawberry and dairy. Because I can accept your fruit at the height of ripeness and beauty, and you're 2 hours away from me or an hour away from me, and I'll put it right into the continuous flow.
Yeah, it changes everything.
It changes everything.
You've made this comment, people don't believe their bullshit regarding climate change. It sounds like a sense of frustration. Is that cynicism or is that, I'd just like to understand that.
It's opportunity. People say a lot of things. You're an investment manager. You've been in the investment world. The reality is that in 2006 and 2007, there were leading indicators of the bubble. And in fact, they weren't forecasts. They were actually leading indicators, right? In Q2 1, 2, and 3, and 4 of 2007, Lennar posted numbers that showed the difference between the days of outstanding inventory in residential construction, all right, and the amount of what they perceived to be speculators versus homeowners. And they posted numbers that showed the tailing off. I mean, if you were paying attention to it and actually believed in the analysis, you'd have gone risk off at that point.
So your point is that people talk about it, but in the end, they don't believe it? Or is it inertia? What is it?
It doesn't matter. It's all the above.
You're just saying it's like no movement until there's a crisis.
And this is why this is interesting. So if you asked 100 of your best friends that were all, quote unquote, seasoned investment professionals, 12 months before COVID, hey, is there anything funny happening in the energy industry? Unless they were energy traders, most of them said, yeah, some of the oil companies are seeing some shocks. Would any of them actually have paid enough attention to know that the oil industry was already being valued a year and a half ago with no enterprise value? That the terminal value of corporations from a public stock market valuation standpoint was being valued at nearly zero. Right? Would they have observed anything about Aramco's IPO that wasn't just about MBS and Saudi Arabian snark? And that the big conclusion is, oh my God, they value the oil industry at basically no terminal value. This is Philip Morris 15, 20 years ago being valued for the cash flow in a cigarette and not for the enterprise value or the IP of the cigarette. Ruh-roh.
Yeah. So a lot of indicators, but for a number of reasons, people don't take note until there's a crisis.
And this is where I fundamentally differ from a lot of the sustainability and impact stream, which is there's greenwashing or this or that, or what's your real motivation? In some sense, who cares? There's a set of changes that are taking place. You're on the right side or the wrong side of the asset. I was joking about this today with an old friend that's 30 years in the oil industry, right? And I said, look, there's going to be 100 companies in oil, and 2 of them are going to decide that they're going to go down with the ship, but they're going to take an aggressive last man standing strategy, which works. And then there'll be 5 of them that go, we're going to get on the right side of the shift. And 95, 93 of them are going to employ McKinsey to go do an engagement on what to do. And they'll do the same engagement 4 years from now. And frankly, you can live either strategy. I'm going to be the last man standing. I'm not an idiot. I know that the world is coming, the world of oil is coming to an end, but I'm going to create the strategies aggressively and proactively to be the last man standing. Okay. And I will adjust my business model accordingly. I'll own all the assets that no one else wants because they do have a life, and I'm going to go down with the ship. Okay. But in the meantime, there's money to be made and value to be created. I'm going to get it on the right side of history, and I'm going to be Shell, and I'm going to call myself an energy company, and I'm going to shift my assets. I'm going to shift my R&D. I'm going to do all that. And the other 95, I'm going to sit there and go, we know that the world is changing. It's a very complex issue. I think we need an offsite. It's not lack of IQ points. They see it.
Yeah.
It's very complicated.
Dave, I know you got to go. I appreciate you taking the time.
All right. We'll talk to you soon.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.